And so let me tell you real quick what risk aversion does not mean, right? Risk aversion, and this is an extremely common misconception, so I don't want you to get confused. Risk aversion does not mean that they want to preserve their capital more than they want to make an above average return. That does not mean that you are the risk averse individual, because there are varying degrees of risk aversion. But what they're saying is just, being any level of risk averse, then you don't want to take risk. That is not the case. We know that I am extremely risk averse, and I don't have a problem with, putting all of my money in stocks. But there may be another risk averse individual, somebody who thinks in a risk averse way via the definitions we've talked about previously, and they don't want to put all of their money in the S&P 500, or they don't want to invest in small cap indices that could provide higher returns. So this is not necessarily the case. So in the same vein, then we also need to understand that the risk averse investor is not the investor that is only going to choose to just save money in a savings account. And they're not just the ones that are going to choose certificates of deposit, CDs, which we've talked about before. That is not just what a risk-averse investor is. And a risk-averse investor is not just going to be the investor that just chooses to invest in bonds very heavily, corporate bonds, municipal bonds, treasury bonds, things of the like. Risk-averse investors are not going to be the stock investors that just invest in dividends-paying stocks because they don't want to take risk and they want the guaranteed income, all this stuff. That does not mean that they are the only people who are risk-averse. People do that, and they do that out of their level of risk aversion, but that does not make them the rule of risk aversion. That does not make them the only risk-averse investors. Investors who are out here that are investing in individual stocks and owning small portfolios of individual stocks and putting a lot of money into, single companies and taking on a lot more individual single stock risk are still risk averse. They still know that they are taking on a certain amount of risk in order to try to make a certain amount of return. That doesn't make them not risk averse because they are choosing to do this type of thing. It just makes them less risk averse than somebody else who may choose a more conservative allocation of their money. But I just don't want you to think that being risk averse, one, is a bad thing. Risk aversion is not a bad thing. It is normal. It is how we think. We think within the terms of risk aversion in many of the choices that we make in our life. Risk aversion is not a bad thing. You can still make high returns and be risk averse. You can still make good returns on your money and still be a risk-averse investor. People do it every single day. And being risk-averse does not mean that you don't want to take risk, okay? Risk-averse just means that you are going to compare the amount of risk that you are willing to take with the amount of return that you expect from that amount of risk. And this is how you go about making a lot of your investment decisions.